In this video, we will learn about how to consolidate foreign operations in the consolidated financial statements under IFRS. You are watching Accounting Zero to Hero. From the previous video, you have learned about the consolidation steps under IFRS 10, which are composed of harmonization, combination, and elimination. This video expands the discussion about the harmonization concept, specifically about how to harmonize the currencies within the group when some of our subsidiaries are using a different functional currency as the consolidated financial statements. This topic is covered by IAS 21, and we have posted a video in the past about its general summary. This video would cover the practical applications of the second half of the standard pertaining to foreign operations. What are foreign operations? It is a subsidiary, associate, joint venture or branch whose activities are based or conducted in a country or currency other than those of the reporting entity. When a foreign operation has a different economic environment, resulting to a different functional currency as that of its parent, we need to find a way to translate its financial statements to the same currency of the parent so that we can consolidate. This is where the concept of presentation currency comes in. The presentation currency simply means the currency in which the financial statements are presented. This is the balance sheet of the parent and the subsidiary that we're going to consolidate today. In this example, parent A's functional and presentation currency are already both in euro. Therefore, we can only consolidate in euro. However, the functional currency of subsidiary B is in USD. Now, we have to find a way to harmonize both financial statements so that we can proceed with the combination and elimination processes. Now, let's find out how to do it through this practical exercise. IAS 21 tells us that each line in the trial balance of a foreign operation should be translated to the presentation currency using specific exchange rates. All the following examples assume that both functional and presentation currencies of the parent and the subsidiary are non-inflationary in nature. Now we move on to the translation of assets and liabilities in the balance sheet. They should be translated using the closing rate at the reporting date. The closing rate is the exchange rate at the end of the period. From here, we assume that 1 USD is equivalent to 0.9189 euro as at December 31, 20x1. This is the closing rate that we will use to convert all assets and liabilities of subsidiary B. The translation process will look like this. All line-by-line assets and liabilities of subsidiary B are multiplied by the closing exchange rate. The product of the two would then be the euro balances of subsidiary B as at December 31, 20x1 for assets and liabilities. But we are not done yet. IAS 21 specifies that income and expenses should then be translated using the exchange rates at the date of the transactions. However, since this is very impractical to do for most situations, the standard allows us to use the average rates for the period for income and expenses. However, this requirement is not applicable if the exchange rates fluctuate significantly during the period. From here, we assume that for the period January 1 to December 31, 20x1, the average exchange rate between USD and Euro is 0.8962, which means that 1 USD is equal to 0.8962 Euro in average during the period. Same as for assets and liabilities, we just need to apply the exchange rate to each line in the subsidiary B's profit and loss statement. You just multiply the two columns and then you will get the net income of subsidiary B in euros for the period January 1 to December 31. You will notice that the process is not done yet because the trial balance is not yet balancing. This is because we have not yet translated the equity items and determined the currency translation adjustment. We will discuss that next. Translation of equity items. The standard is silent about how to translate the equity items in the balance sheet. In practice, we use the following convention that I will be discussing shortly. Of course, you may use other exchange rates, but they need to be applied consistently from period to period. For share capital and share premium accounts, they are translated using the historical rate when they were first issued. This will ensure that the translated amounts eliminate completely with the investment in subsidiary accounts at the parent level. For example, we assume that the share capital were issued on January 10, 20x1, when the exchange rates between USD and Euro is 0.9297. This is the historical rate that we will use every year to translate Subsidiary B's share capital account. This will never change in subsequent years. And in case Subsidiary B issues new tranches of share capital in subsequent years, each tranche of additional share capital issuance is translated separately and will have their own historical rates. In this example, you will notice in advance that the translated share capital in euro of Subsidiary B is equal to the investment in subsidiary in the books of parent A. The retained earnings are never translated using historical rate, but follow the roll forward principle. This means that the previous historical profit or loss amounts in presentation currency are simply accumulated in the presentation currency balance of the following year. This ensures that we maintain the integrity of the previously audited retained earnings from the previous year. In this example, we note that there are no retained earnings yet, so there is nothing to roll forward. But we will follow a second year example later showing this concept. How about the other equity items? The subsidiary possibly might have other items in equity, such as items accumulated directly in equity coming from gains or losses on revalued property and intangible assets, debt instruments measured at fair value through other comprehensive income, gains or losses on cash flow hedges under IFRS 9, and deferred taxes recognized in OCI as per IAS 12. IAS 21 does not specify how to translate these items, hence it could be appropriate to use closing rates for them as well. For this example, we don't have other equity items, just share capital, share premium, and retained earnings. The Cumulative Translation Adjustment. At this point, you have already determined the presentation currency equivalent of Subsidiary B's assets, liabilities, income, expenses, and the equity items. However, despite this, the trial balance is not yet balancing, and it's because of the different exchange rates we have been using all throughout the financial statements. The standard mentions that all remaining exchange differences go to the Cumulative Translation Adjustments or CTA account in equity. The movement of this balance during the year goes into the other comprehensive income in the statement of comprehensive income. Since the current year is also the first year that we are doing this, the beginning balance of the CTA account in equity is 0, and the full amount we determined will be the CTA movement that will show up in the statement of comprehensive income. To see the full impact of the CTA adjustments, it is best to continue learning until the second year of operations in the next part of this video. We normally just have to simply plug the remaining difference into this CTA account to balance the debits and credits of Subsidiary B, just like this. The Cumulative Translation Adjustment account in equity is tagged to a specific subsidiary and is allowed to be recycled to the P&L if the specific subsidiary will be disposed in the future. In case this happens, you just have to reclassify the CTA balance to the gain or loss on disposal. The Combination and Elimination process. It is only at this point that we are ready to move on to the next steps. Since we have already translated Subsidiary B's TB into Euro, we can forget for now the USD trial balance or financial statements and start working on the Combination and Elimination. In combination, we just add all euro balances into one column, and in the elimination process, we target to remove all intercompany balances and transactions. In this case, we only have the investment in subsidiary versus Subsidiary B's share capital to eliminate. However, all other elimination entries discussed in the previous video are still applicable. We just tried to simplify it in this video. And now we consolidate all the columns. This is the consolidated financial statements for year 1 of Parent A Group. One way of reviewing your consolidation, especially when it involved foreign operations, is to prepare the statement of changes in equity. This is one of the main financial statements and it shows the specific movements of the equity items at consolidation level. Subsidiary B was acquired on January 10, 20x1. So this is the first consolidated financial statements of Parent A. But since this is not the first year of operations of parent A at standalone level, the beginning balances of the equity items are not zero. Here we assume the previous year's net income was already close to the retained earnings account. The next portion of the changes in equity is the comprehensive income during the year, which is composed of two items. The net income in the P&L amounting to 44,696 euros, and the other comprehensive income from translation of foreign operations amounting to a debit or a loss of 2,204. There are no other equity items to account for, so the next step is to add all the rows from the beginning balances and all the movements. We have to ensure that the ending balances agree to your balance sheet. The statement of changes in equity gives you a story of the net asset value of the entity during the period. In this example, we are showing that after the acquisition of Subsidiary B in January 10, 20x1, the Consolidated Group earned 44,000 euros of net income from the operations of Subsidiary B and the operations of Parent A. And since Subsidiary B is also a foreign operation, we have incurred currency translation losses of around 2,200 euros, resulting from the translation of USD to Euro balances. It will give you so much more value when you continue doing this in subsequent consolidations, just like the one that we will discuss next. In order to expand further on how equity items are translated into the presentation currency, imagine that in the next year, the balance sheet and income statements of Parent A and Subsidiary B look like this now. We are tasked to consolidate this further for the year end. We will use the following new sets of closing and average rates for the year 20x2. Reminder, before doing anything else, make sure that each company you are consolidating did their accounting correctly. One main thing to check that affects the consolidated balances is if the standalone equity is rolling forward for each entity. We can do this by checking the current and previous year balances side by side like this. For the parent, the previous year's net income plus beginning balance of the retained earnings in the previous year's financial statements should be exactly equal to the current year's beginning balance of retained earnings. Any differences should be investigated. Same goes for the subsidiary. The previous year's net income in USD plus the beginning balance of retained earnings in USD should be equal to the current year's beginning balance of retained earnings in USD. Any difference should be investigated. Now that we see that the balances are okay, we can proceed. Let's go to Subsidiary B's financial statements in USD. For this new period, we need to translate it again into Euro so that we can consolidate them to the balances of the parent. To do that, we still follow the convention that assets and liabilities are to be translated using the closing rate as at December 31, 20x2. And we also translate the income and expenses using the average rate. We do this line by line. What we do is that we just multiply or divide as applicable the column of the functional currency of the subsidiary to the exchange rate. And then this column now shows us the assets, liabilities, income, and expenses in presentation currency, which is the euro. For the share capital and other equity items, it is best to do translations while also looking at the euro balances of Subsidiary B in the previous year. This will help you in understanding the adjustments better. Since Subsidiary B did not issue new share capital during the period, you will see that there is no change in the USD balances. The existing share capital will be translated using the same historical rate when it was originally issued in January 10, 20x1. By doing this, you will notice that the euro equivalent of the share capital and share premium for the year end 20x1 and 20x2 are exactly the same. For the retained earnings, we will need to do it on a roll forward basis with the following formula. The ending balance in the prior year in presentation currency plus or minus any profit or loss in presentation currency in the previous year. It is equal to the ending balance in the current year in presentation currency. This amount is what we'll use in the balance sheet of the current year. Also, the ending balance in the current year will be used in the next year's retained earnings roll forward formula. You will see that there is no specific exchange rate to use because essentially the total of the retained earnings becomes a cumulative of all P&L, historical, or average rate translations all throughout the existence of the company. Once the ending balance of retained earnings is determined, All other exchange difference are also booked in the Cumulative Translation Adjustments account, or the CTA. These exchange differences are determined by the amount of euro it takes to balance the financial statements of Subsidiary B. From here, we see that the CTA account in equity amounts to a credit balance of 3,200. It is good to note that this amount is already cumulative, which means that it includes all the CTA that we have recognized in the past, which is 2,204. The movement from 2,204 to 3,200 in credit, or a net movement of 5,404, will be the amount that you will see in the Statement of Comprehensive Income as part of the OCI from Translation of Foreign Operations. You will also see this further in the preparation of the Statement of Changes in Equity. After we finalize the translations, we can now move on to the combination and elimination process. Same as in 20x1, we need to combine all euro balances. In the elimination process, you will see that the eliminating entry from 20x1 and 20x2 are exactly the same. This was made possible by translating the share capital at historical rate. Just like in year 1, it is best to prepare the Statement of Changes in Equity to better review the consolidation. Last year's ending balances will be this year's opening. We have also noticed that the parent's shareholders have contributed an additional 30,000 euro to the share premium account. We also need to move the previous year's net income into retained earnings like this. Most importantly, we need to show the total comprehensive income during the year, which is composed still of two items: the net income in euro and the movement in Cumulative Translation Adjustment account in equity. The total of the two is what we call the total comprehensive income. The next step is to add all the rows, and then we will have the ending balances of the equity accounts, which should all agree to the balance sheet. Most importantly, you will see that the ending balance of the CTA account is exactly equal to what we have computed in the balance sheet. And the movement of the CTA account is what we recognized in the OCI account. I hope you found this video super helpful. Practice this and you will be consolidation experts in no time. See you in the future installments of the Bite-Sized Accounting series.